So let's have a sesh on gross profit margin. Gross profit margin, sometimes referred to as GPM, and where you find the numbers that you need for the GPM, the gross profit margin, is on the income statements. Remember that. So let's go through gross profit margin. The formula is gross profit divided by revenue times by 100 because it's a percentage. You've got to remember this formula, but it's very simple to remember, especially when you look at it visually. Because you're thinking about income statements is where you're going to calculate your gross profit margin. So let's look at an income statement and calculate the gross profit margin. Well, it's going to be simply your gross profit, the top profit, the first profit that you find on an income statement. And in this case, gross profit is £150,000 to be precise. And your revenue or your turnover is £200,000. So simply putting these numbers in, you'll put 150 in for gross profit, 200 in for revenue, 150 divided by 200 times by 100 is going to come to 75%. So that 75% is what the gross profit margin is for Chocksesh in 2020, the year 2020. And what that 75% means for Chocksesh in terms of their gross profit margin is that for every £1 of sale that they make, £1 of turnover, 75p of that is gross profit. Is gross profit being the first profit. Key details to know about gross profit margin. So number one is the higher your gross profit margin is, the better. You want it to be as high as possible. The reason why is because it says how good you are as a business. How good you are as a business when you're referring to how well you can produce, how efficiently you can produce, and how accurate you can price, because you're able to charge the most amount without limiting your sales. So it's about how you're producing and how you're pricing. Number three is that if you calculate your gross profit margin, well, it's going to help inform management to make better decisions. Because now they've got a gross profit margin, they can compare this gross profit margin to previous years in the business to see if it's trending. Is it trending in a positive direction or a negative direction? If it's trending in a negative direction, maybe that suggests that the business is producing their goods, their cost of sales, less efficiency, so they're becoming more inefficient. And also, management can use the gross profit margin to compare to rivals in the same industry. They might be rivals that are different sizes in terms of the amount they make in turnover or revenue. But nevertheless, you can see how efficiently they are producing because the gross profit margin is looking really that cost of sales versus the turnover. So you can compare to rivals in your industry, and it might be rivals of varying sizes. Maybe they are smaller than you in terms of turnover or larger than you in terms of turnover, but it looks at it from a percentage perspective. Fourthly, an important thing to think about gross profit margin is the introduction of technical economies of scale, because maybe you have got a situation where your gross profit margin is not as high as you would like because of your cost of sales, your direct costs being higher than you want. And remember, you're just minusing them off to get your gross profit. So introducing technical economies of scale, well, it might actually lead to increasing your gross profit margin, because with technical economies of scale, you're effectively introducing capital. You're introducing machinery into your business and therefore using less people, less labour. And if you are reducing your average direct cost per unit, you are effectively reducing your cost of sales. And if you're reducing your cost of sales, you're increasing your gross profit. And if you're increasing your gross profit, you're increasing your gross profit margin. So there is a relationship here, a concept link between technical economies of scale and improving your gross profit margin. And the final thing to remember with gross profit margin is that it's always going to be higher than the other profit margin that you need to know, which is your net profit margin. It's always going to be higher, simply because it's higher on the income statement. So only cost of sales is being taken from revenue, versus if it's net profit margin, you're having cost of sales taken out, operating expenses taken out, interest and taxes taken out. So lots more are being taken out. Therefore, your net profit will be a lower number, and therefore your net profit margin will be smaller. And if you want to hear more about net profit margins, make sure you click the link right there now. I'll see you at the next video.